Hey everyone, welcome back to another episode of AWM Insights. Plenty going on in the markets. We just had a month end, always brings some new headlines. So kind of without further ado, we're just going to jump right into it. Talking today about data-driven long-term investing. Not the most interesting title. We'll work on our creativity in title creation there, but it's just an important reminder here that we wanted to focus on, given what's going on this week, all the volatility. It was Trump's first 100 days. And it's just a good moment to talk about data-driven long-term investing and how to really make those decisions, remind everybody about focusing on the long term when there is a lot of noise here. So it's a noisy world. We want to cut through that and start, I guess, with highlighting some of the noise. So Mena, take it away. What happened in the markets this week? Let's level set, give a foundation of what we're talking about.
Yeah, and the markets have been recovering this week, and that's been a general trend since the beginning of the month. At the start of April, things looked very, very bleak. We had some positive trade news come out that created a little bit of a rally, and now we're getting some more favorable economic metrics that are coming out on the earnings front, a little bit on the economic activity front as well. That's a little bit more of a mixed bag. But as of today, we had some positive Microsoft and Meta earnings, which really eased investors' just paranoia over the past month, and it prompted a little bit more of a rally. So just some favorable news, some tailwinds that have reversed a lot of the skepticism and the negativity that we saw earlier in the month.
Yeah, and it's worth also noting, I think most people probably would have seen the GDP headline that it was negative. That was, I think we've talked about it in a couple of the previous podcasts, that was a lot of front loading. So there's, let's call it devil's in the details on that. Was it a bad data point? Yeah, I mean, it does show some contracting in the economy, but I don't think we've seen the full impact or brunt of some of these tariffs quite yet. And, hopefully it's all solved and we don't really see those in the data. But it's a perfect example. Like, that's noise, right? GDP was negative, headlines everywhere. There were some positive headlines, right? Noise can be good and bad. Why do we need to have this conversation and even talk through some of these data points, but then take a step back and remind people, hey, this is noise. This can really derail you. Don't let this get in your way.
No, and noise is real. Noise is scary. You look at your portfolio on April the 8th and it's down, 10 to 15%. That's scary. But that is just one point in time. And if we've learned anything from markets over long periods of time, it's riding those waves, going through these downturns it's always going to happen. You're always going to have market pullbacks, but getting to the other side of that is where your benefit really, really lies. We were having this conversation, I believe, last week. If you're a baseball pitcher and you're in a slump, you're not going to change your mechanics
Right.
because you don't have, a good couple days. You're going to ride it out. You're going to focus on potentially other things, believe in your process, believe in your preparation, and you should come out in a better spot. Probably a lot better off than you would be if you just totally changed all of your mechanics, your process, your warm up. So I think there are parallels there where riding the volatility and just believing in the foundations and the fundamentals of the markets can really benefit you over long term.
Yeah, and it's a great analogy, right? You don't want to change something in your routine just because you run into a couple bumpy days. You don't want to have a knee-jerk reaction with investing because of some present day volatility, right? There's a temptation. There is this visceral reaction, but we know from history, from data, that doing that, 9 times out of 10 or whatever, the vast majority of the time, if not every time, is a bad leads to bad outcomes really, and missing out on recoveries, because when they happen fast. Um, so we've talked a lot about what's going on currently, why you want to tune out the noise. I teed it up to talk about data-driven investing. Like, what is that? We'll just take a quick step back and talk through what actually is data-driven investing. Put a little context to it, and really simply, it's looking at data. Obviously, it's in the title. Historical trends and applying much more rigorous statistical analysis to guide investment decisions, as opposed to just this like gut and feel or a knee-jerk reaction to present day noise. We know it's very, very difficult to predict the future. Markets are efficient, so they're incorporating all this information. And so if you don't have this data-driven approach ahead of time, when those periods of volatility come come to reality, because they always do, you're not set up to deal with them properly. You want to acknowledge that that's going to happen because the data shows that happens historically, but you want to have a framework to deal with these periods of time based on historical data. So we know volatility happens. We know we don't want to react to it in a knee-jerk way, and we want to rely on what the research, the academic research, the industry research, etc. Tells us over periods of time. It's not to say we don't, using our good old friend Brian Kane's model of reflect and refocus, right? We're always asking ourselves the question. We don't want to say, is this time different, right? Because the data doesn't really favor that mindset. But we do want to reflect and refocus and say, is there additional data that is available now that informs us to make better decisions, better portfolios, and really a better investing outcome overall. So that's the simple definition. Why don't you give us some daily applications of data-driven investing and how we think about it?
Yeah, and the first one you hit on it is staying invested, not bouncing in and out of the market because of short-term noise, because of, your emotions, what might be happening, staying diligent, staying invested, sort of like showing up to work every single day, even if you don't feel great. And if you know that you're not going to have a great day, staying disciplined and staying on course is one of the most impactful. I think the data really shows it's probably the most impactful thing that you can do over the long term. So not timing markets. Diversification is, a lot of people say it's the only free lunch in finance. Having your assets spread across a lot of different investments that move in different ways with different market environments, that's critical. This latest downturn, if you're a client, you could see potentially US markets were dropping a lot more than international emerging markets. And then the bond portion of your portfolio remained pretty stable. So even though you saw a sell-off in some regions, it wasn't as, sharp in all areas. And you also had the benefit of, equity and fixed income diversification on that end. So staying invested, diversification, not stock selecting, not stock picking, and thinking that better than everyone else. I think especially in a time like this, that could be really, really hurtful and really damaging. We've seen sharp sell-offs in NVIDIA and a lot of the positions that people were really bullish on, and there was a lot of hype around. So not stock picking because, things can change really, really quickly. I think those are potentially the three most important data-driven strategies that you can implement.
Yeah, that's awesome. So we'll go ahead and wrap here, try to keep this short and digestible for everybody, but a couple quick takeaways, right? We really want to focus on long-term goals, not the short-term noise that's really always present, both good and bad, like we've talked about, and rely on data, right? That's our role. That's what we're doing for you, our clients, and really making informed decisions, having portfolios that are constructed using a very rigorous data-driven approach instead of just emotional reactions to what's going on in the world around. Diversify and focus on what you can control. Like that is something that we say a lot and certainly focus on day to day from an actual implementation standpoint, right? We can't control the markets, but hey, if markets are down, we can do what's called tax loss harvesting, right? It's kind of making lemon lemonade out of lemons. And then market volatility is normal. We know it's going to be there. We don't know exactly when it's going to be there, but having this data-driven mindset and application from the get-go is a way to help stay the course and stay disciplined through times that are uncomfortable. I mean, there's no sugarcoating that. So it's just a good time to reflect and refocus on this past week and how a data-driven approach can really help us. And just don't let emotions get in the way, really, is the quick takeaway. So hopefully this was a good reminder. It's a topic that you probably can't talk about enough. These reminders really should give you comfort and appreciation, I guess, for the current market environment. So with that, we're going to wrap. Own your wealth, make an impact, and always be a pro. See you next time.